Is it the end of high rates? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly update. Treasury yields were down across most maturities in a shortened trading week as markets digested a slew of economic data and President-elect Trump's pick for Treasury Secretary, Scott Bessent. So with that in mind, here are the three topics that we'll be covering in today's update video. 1. What is Treasury Secretary nominee Scott Bessent's 3-3-3 plan for cutting the budget deficit and lowering rates? 2. Which treasuries rose and which ones fell this past week? And 3. What's on the upcoming Treasury auction schedule? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. For many in our Diamond NestEgg community and market observers in general, the Treasury Secretary is one of the key nominations in every new administration, as the position is very powerful and has direct influence on the U.S. deficit, treasuries, and financial markets overall. Scott Bessent, President-elect Trump's nominee for Treasury Secretary, is not an unknown on Wall Street. He joined Soros Fund Management in 1991 and made his name there. Many see this as a bit ironic, as George Soros, the namesake of Soros Fund Management, is a prominent big-time supporter of liberal causes. That said, after a bit of back and forth, Scott Bessent finally left Soros in 2015 to start a new firm, Key Square Group, that is still active as a fund manager. Now, from what we can read in the media, Scott Bessent didn't win the nomination for Treasury Secretary without a fight. He beat out Howard Lutnick, the chairman and CEO of Capital Markets from Cantor Fitzgerald, another well-known player in financial markets. Many voices welcome Scott Bessent's nomination, as they see him as a steadying force at the Treasury who's committed to maintaining the status of the dollar as the world's reserve currency. Elon Musk seems to have the same expectation that Bessent will not rock the boat, but expressed his disapproval by labeling him as the business-as-usual choice on social media. In recent interviews, Bessent has said that he would implement Donald Trump's election promises around making the 2017 tax cuts permanent, exempting tips from federal taxation, meaning gratuities, unfortunately, not Treasury inflation-protected securities, as many in our channel would have hoped, exempting overtime and Social Security from federal taxation, and rolling back regulations. Bessent has also expressed his willingness to enact the tariffs that President-elect Trump spoke of during his campaign, although in some earlier interviews, he hinted at a pragmatic and business-like approach that would try to negotiate deals with our trade partners before slapping punitive tariffs on their exports. Time will tell, I guess. So far, so unsurprising. The really interesting observation, though, is that Bessent seems to already have a strategy on how he wants to get the U.S. deficit under control, keep the U.S. economy growing, and ensure that treasuries will remain the world's favorite bond investment. He even found a catchy name for his ideas, the 3-3-3 plan, apparently inspired by a similar plan promoted by the late former Japanese Prime Minister Shinzo Abe. No more than a 3% budget deficit, at least 3% GDP growth, and an additional 3 million barrels of oil production per day. While the 3 million barrels of additional oil production may sound a bit random in the grand scheme of things, we here at Diamond NestEgg would certainly welcome a 3% budget deficit and 3% GDP growth. As we explained in this recent video on the U.S. debt crisis, linked below for your convenience, our country's overall debt pile would stabilize as a percentage of GDP if the deficit does not grow faster than the overall economy. Of course, Bessent still needs to be confirmed by the Senate, and even after confirmation, there's no guarantee that he will be able to cut the deficit while at the same time stimulating economic growth through deregulation. That's no easy task. And the latest round of economic data seems to somewhat muddle the path forward for lowering rates as well. regardless of who eventually will be confirmed as the new Treasury Secretary, which is a great segue into the next section of this video. As we so often do at the end of the week, let's compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. The 1 month and 2 month were up by a few basis points, but everything else across the maturity spectrum was down, largely driven by market optimism that new Treasury Secretary nominee Bessent would help bring our budget deficit down, as we just talked about. Bessent's nomination overshadowed 3 key economic data points. 1. The U.S. economy is still growing strongly. Real gross domestic product, GDP, increased at an annual rate of 2.8% for the third quarter. So we're already quite close to the 3% GDP that Bessent is targeting as part of his proposed 3-3-3 plan. 2. Minutes released from the November FOMC meeting indicated a more gradual pace of interest rate cuts for 2025. And 3. The Fed's preferred inflation gauge, PCE, started inching up again last month. PCE stands for Personal Consumption Expenditures Price Index. The PCE numbers had been going down steadily since July, but in October, it went up again to 2.3% year over year. And core PCE, which excludes food and energy prices, went up even more to 2.8% year over year. All 3 of these points seem to indicate that inflation might not be as dead yet as many were hoping, and point to a less certain path forward for how quickly rates and subsequently yields will come down, despite the market's confidence and good cheer over Bessent's nomination and potential spending reductions. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black, and decreases in rates are shown in red. Treasury yields across all maturities 2-year and below are still noticeably lower than where they were at the start of the year. The 2-year was not able to hold its gains from last week, and is once again lower than where it started the year. Everything 3-year and longer is still above where it was on January 2nd of this year, although much of the gains were given back last week. In fact, the 3-year T-note, which was 23 basis points above where it started the year last week, is now only 1 basis point higher than where it was on January 2nd. The yield curve remained negative and once again widened significantly last week on the extreme ends. The negative difference between the 1 month versus the 30-year now stands at 40 basis points again, versus 12 basis points last week. That said, this is still substantially less than the 147 basis point difference at the beginning of the year. And the widely used comparison of the 2-year versus the 10-year Treasury, which has been in positive territory for a bit now, has remained there, with the positive difference at 5 basis points this week. So not very different from the 4 basis point positive difference from a week ago. As we mentioned last week, this may or may not be significant as an indicator that the yield curve may turn negative again. It's too soon to tell, but we'll definitely keep watching the space here for you at Diamond NestEgg. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. Other than that, it's pretty quiet on the Treasury auction front. For those of you who may be interested in other types of bonds for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one again from FHLB at 5.95%. This is quite a bit lower than the highest yielding FHLB new issue from last week, which stood at 6.25%. But in any case, the first call date on this bond is in March 2025. Here's the CUSIP for those of you who may be interested. For corporate bonds, the list on Fidelity is quite a bit shorter than last week. Perhaps everyone was busy with Thanksgiving. Here's where the highest yielding new issues stand at the moment. The highest yielding one this week is from Dow Chemical at 5.6%. Again, this is quite a bit lower than the Deutsche Bank new issue from last week, which stood at 6.05%. The first call date for this Dow Chemical new issue is June 2025, also shorter than last week's Deutsche Bank bond, which had a first call date that was 12 months out from the time of issue. Nonetheless, here's the CUSIP for the Dow Chemical new issue for those of you who may be interested. For brokered CDs, the yields are as lackluster as they have been recently. And like the last 3 weeks, the highest yielding one is from Jonesboro State Bank at 4.6%, with a first call date of March 2025. It's hard to believe that we're already in the final month of 2024, and interesting to see how much has changed over the past 11 months, and how much has stayed the same. As some of you who've been with us for quite some time know, we have a great, growing, and supportive community of fixed income fans at Diamond NestEgg. And every single one of you has been an integral part of our financial journey at Diamond NestEgg. We already have some super exciting videos and plans that we will be sharing with you in the new year. But as we grow, we have gotten feedback on a wider range of topics that some of you want covered on this channel. So, for those of you who may be interested, I've linked this Google form below for you to give us even more detailed feedback on what you want us to focus on in 2025. The survey is completely anonymous, unless you personally wish to provide your email for us to follow up. While I cannot promise that we will be able to implement every suggestion you give us, do know that we will do our best to incorporate your ideas and suggestions in our plans going forward for this channel. And I thank everyone in advance who will be completing this survey and contributing to all that we will do here at Diamond NestEgg in 2025 and beyond for you. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to really get up to speed on bond investing and building out your bond portfolio while rates are still quite attractive, then check out this video here on our 2024 bond courses. Or come join our live sessions in December. Our next Bond Masters Live will be on Sunday, December 8th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. And our next YouTube Member Live will be on Thursday, December 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's upcoming Treasury auctions and other new issue bond offerings. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. See you again very soon with more brand new wealth building content for your financial journey.